Good afternoon, class.
Good afternoon.
Good afternoon. I think we are expecting about 30-something people.
They will join. We are letting them
Yes. So we have more than half. So I think we can start as you are letting them to join. Is that fair enough?
Yes, please.
Okay. Yes. So my name is Bright Ferguson Laing, and I'll be facilitating the class for today. Kindly give me a few minutes. Sorry, I'm having the class at home, so you can imagine all that's happening around here. All right. So my name is Bryce Ferguson Lane. I think last week we showed our faces. So let me see if I'm trying to show my face again. It won't show. Is it showing somewhere?
Yeah, it's showing.
It's showing. Okay. Okay, I can see. Yes, it's showing. So I'm here. And this is me. For the sake of my network, I would want to go off video. But at least I wanted you to see who is behind the voice over there. Okay.
Very well.
Thank you. So can we do a recap of what we did last week? If just let's do a recap. What do we remember we did last week? What did we take along with us? What have you read over the week? And let's know. So we had an introduction of financial markets. Yes. Emmanuel.
Yes, Doc. Good afternoon, please.
Good afternoon.
Okay, so please, last week we talked about financial markets and then financial intermediaries. And what I took from it was the structure in the financial market or the financial system. We talked about direct finance and indirect finance. So we said that with the direct finance, the buyer and the seller meets together without any intermediary. They meet together and then do their business transaction in the financial markets. While with the indirect finance, there is an intermediary, a financial intermediary who sees to the legal the legal agreements and the negotiation between the buyer and then the seller. So with the direct finance, it is done at the over the counter. There is no legal backing towards it. So there is a high risk of default in that market. But then when it comes to the indirect, because it has the backing of the intermediary, the financial intermediaries who sees to the legal agreement of the contract or the business transaction, it ensures that there is no default, so that the risk there is a bit low. Thank you.
Okay. Anyone else? I would say something about that, but any other? Anybody else? I don't think all we did was on direct and indirect finance. So
Yes, Doc.
yes.
Okay. I think we've talked about the structure of the financial market as well.
Okay.
Yes.
What do we remember there?
You have debit market and equity markets.
Okay,
So
good.
debit market, it explains about the short term, that is the maturity. Say the maturity is 1 year.
Okay,
So long term, the maturity will go up to 10 years.
okay,
Intermediate term, the maturity is in between,
in
as you
between.
expect. Yes.
Okay,
Whereby
yes.
the equity market, you've talked about the offer investors. Then after we have our shares or stocks trading opportunities.
Okay,
You have an ownership claim in a firm.
okay,
You receive dividend in theory forever.
okay,
After then, you've talked about equity holder is a residual claimant. Then the
okay.
final one is examine the pros and cons of debt versus equity
Versus
instruments.
equity. All right. Okay.
Yes.
Yes. Thank you very much.
All right.
Anybody else wants to say something? I like my class to be interactive because this is not a degree or a secondary school. I understand that we know in a lot. We are just topping up. So I would like the class to be interactive and so that we can all learn from each other. Ima, I can see your hand.
Yes, Doc. So, Doc, please, we also talked about the primary and secondary markets. We said that in the primary markets, that's when any shares or any shares is in the primary markets, we buy new shares
Yes.
from the primary markets, and then
Yeah.
in the secondary market we buy existing
Existing
shares. Yes, please.
shares.
Yes, please.
Okay.
Thank you.
Thank you. Can anybody give an example of how the primary and secondary markets work? Like, when do we say that this is happening in the primary market and the other is happening in the secondary market? Any other person? Any other person? At what point do we say that this activity is happening in the primary market? And at what point will we say this activity is happening in the secondary market? If my question is clear. There are lots of us here.
Hello, madam.
Yeah.
Madam.
Yes. Is it Victoria? Uh, just speak. Yes. Who is speaking with me?
Hello, madam. This is
Yes.
Gloria. I want to give it a try.
Yes.
So let's say MTN came in new as a company and they want funds from the public.
Yeah.
So they go through the listing process with Ghana Stock Exchange, and then they offer their shares to the public that anyone can come and buy. So
Okay.
that is like an initial public offering, and it's done on the primary market.
Good.
So after individuals have purchased their shares and they are holding the shares and they want to sell at any point in time, or someone else wants to buy, then they buy. If an individual wants to buy and the individual buys from someone else who has the share, that is
Yeah.
on the secondary market.
Good. Thank you very much. And that's very clear. So that in the secondary markets, we are dealing with individuals to individuals. We've sold, it's the same, the volume of shares to MTN doesn't change. It's just what they've sold already that's running in the secondary market. So I like your explanation. I like your example. Thank you. And so today, we will look at bonds. We will look at bonds and then go into its features and look at how valuation of bonds is done. Okay, so bonds form one of the instruments we call the debt instrument. We call it a debt instrument because you would repay back to the investor. So we call it a debt instrument. I hope that you can see my screen or my slide. Is my slide visible? Is my slide visible?
Yes, yes.
Yes, please, it is.
Yes.
Thank you. So our learning objectives, we hope to, by the end of this session, be able to look at the fundamental features of a bond, the type of issuers, the importance of term to maturity of a bond, floating rate, inverse floating rate, and insecurities, and then what it means to have an embedded option. Then we'll look at risks, which is also a big part of it. I remember last week there was a discussion on whether bonds were risky or not. So today we'll look at what point do we describe bonds to be risky. Okay. And the theory told us that bonds are safe, especially government bonds are safe. Yes, that is, I think that it's a misconception. It's a general misconception. The idea is that bonds, especially government bonds, are supposed to be safe. But at what point will you call government A or government B or economy A or economy B's bond as risky or not risky? So we'll look at that by the end of this session. Okay. So what's a bond? How will you describe a bond? How will you describe a bond in your own language or in your own terms? How do you understand what a bond is? Anybody? Somebody should try. Most of us have done this before. It's not new. It's not new to us. Those of us who have not even done it before, we've had bonds. We know, some peculiar things about what a bond is. So just put those in your own words for me. And for me, even in exams, I don't even want to see what I've given you. I want you to write in your own language, in your own explanation. So let me hear that one now. Yeah. A bond.
Okay, Doc, I would like to try.
Yes.
Okay, a bond is a debt instrument an investor lends to a government for a fixed period with a fixed rate of interest.
Thank you very much. A bond is a debt instrument, one, where that an investor, two, lends to a government or an institution. So you have it as a debt instrument, having two players in there, an issuer and an issuer who is the borrower and a lender who is the investor. And then when they come together, you have a sort of payment that comes from holding the bond, which we call coupons. I see a notification. Can you make the screen bigger? Okay. Okay. Thank you. Let me make the screen bigger. That is, let me put it on PowerPoint. Okay. Yeah, is it better?
Yes, Doc. It's better.
Yes.
Yes,
Okay.
please.
So you have a bond described as a debt instrument. Then it has two players, an issuer who is a borrower, usually an institution or a government. Then you have a lender who is an investor who borrows this money with an interest or hoping to receive the money and interest. So interest periodically, and then we'll receive the rest of the principal of the money at a certain period. Okay, so we will describe a bond as a debt instrument requiring an issuer to repay a lender or an investor the amount borrowed plus interest over a period of time. You have an issuer, a debt instrument requiring an issuer or a debtor or a borrower to repay a lender or an investor an amount of money borrowed plus interest over time over a specific period of time. And that is how we describe bond instruments. Okay, so with a bond instrument, you have a maturity date and then an amount of interest that is quoted, agreed between the two parties. Okay, the maturity date is what we call the due date. That is when, if it's a 10-year bond, the maturity date will be after 10 years, the 10th year. Then you say that the bond has matured, and then you receive your principal. That's the amount of money that you invested. Okay. Now, sectors of bonds. Sectors. So we have treasury bond, we have agency, we have corporate. We have treasury, which are usually government securities. We have agencies, and then we have municipal. In Ghana, we usually have the government bond, and then a few other agencies. I haven't seen municipal bond yet. I don't know if you have confidence to give your money to a municipal to manage for you, but it is the reason why we are not able to go into that. So we have the corporate, the asset back, and then mortgage. These are all sectors of bonds that happen. Okay. Now we'll look at the features, and I'm going to take it off, and then we'll try and discuss what we know before we go into the slide. Okay. So let's talk about the features of a bond. What are some of the features of a bond that you know? Some of the features of a bond that you know.
There should be an issuer.
There should be an issuer. Okay. There should be an issuer, and that is, who is the issuer?
The borrower.
The borrower. Okay, good. Thank you. Who else? We want.
There
Yes.
should also be a maturity. There should be a maturity date.
There should be a maturity date. A maturity date. That is. I'm going to answer the question myself. That is which one? What is the maturity date for a bond?
That is the day when the bond expires.
That is when the bond expires. Yes. So we have issuer, we have maturity. What else do we have?
The principal. Agreed amount of interest.
Agreed amount of interest. And then someone said principal. So in bonds, what do we call that agreed amount of interest?
Coupon rate.
Coupon rate. Thank you. So that is coupon rate. And then when you turn that rate into value, what you get from it is what we call the coupon. So the rate is the interest, But when you convert the rates into value, then we get the coupon. Okay. And the principal will be the initial investment if we are right. So the principal is the initial investment. Okay. Then what else can we say? Another?
It can also be zero coupon bond.
It can be a zero coupon bond. Yes. Either it is a zero coupon bond or it is a bond that has coupon payments. A zero coupon bond or a bond that has payments coming in here and there. All right. Then we have what we call the embedded option. The embedded option, and we'll go into that as the slides go. When we say something is embedded, it's like something is hidden inside something. So that is the embedded. It has a clause in that hides something in there. It's like you are hiding something in the pocket. So it's embedded in, and we'll go into what the embedded is in details. Okay. I don't want to miss the slide. So the issuer, we've mentioned who the issuer is. Could be municipals, could be federal, and it could be corporations. Then you have your maturity, which talks about when the bond will expire or when the bond must be redeemed. When does the bond end? If I took a 5-year bond, my maturity will be the 5th year. That means the contract is done. I am done with you on that contract. Then we have the principal value or par value. So when you see principal value, it's the same as par value. And that is the amount the issuer agrees to repay at the end of maturity. The amount the issuer agrees to pay at the end of maturity. And then you have a zero coupon bond. That bond doesn't deal with coupons. It doesn't have periodic coupons that are coming in. That is a zero coupon bond. Okay. Then we have the coupon rate, which is the interest rate. And then the interest rate, after you calculate the rate on the value, what you get from it becomes your coupon. All right. Then we have bonds that have amortization features. Some bonds allow you to pay both principal and then a portion of the principal and a portion of you pay the interest and pay a portion of the principal. That is amortization figure. So by the feature, by the time your 10 years or 5 years is done, you have reduced the principal greatly, and that will be the amortization. So let's discuss the embedded option. Now, when we say a bond has an embedded option, it has what we call the call provision or the put provision. These are the very main ones that are usually used. You have the call provision and the put provision. Now, it is common for bonds to issue to be issued with a provision. Now, why am I even showing the thing and going to ask you about it? What is a call provision? Anybody has heard of that before? A call provision. A call. The bond has a call provision.
That's a sell option.
What's the sell option?
The option to sell the bond, or is it to buy? Sorry, to buy the bond. Call will be buy.
Okay.
So an option to buy back the bond.
To buy back the bond. The bond is the deciding factor. So the issuer sold the bond out, floated some bonds, you bought the bond from him, and that bond has an embedded option. If it's a call option, what it means is that you agree that though you have bought this bond for 10 years, the issuer can call back the bond, can buy back the bond, can say that, okay, I'm not doing 10 years anymore. After 5 years, I'm calling back the bond. Come for your money and come for your money. I've paid interest over time, coupon to you over some time. I don't want to keep your money anymore. Come for your money. But why do they do that? Why do we put a call provision in a bond? Why would that feature be there, a call provision? Why do you think that you would buy a bond from an issuer and then over time, you invest in a business, you invest in a bond, you know that these people need the money to do business, and over time they decide that they will call back the bond before its maturity date? What do you think?
I mean, what I'm thinking is because the bond is being taken for a specific problem, to solve a specific problem, and anticipating that, let's say, that problem can be solved within 3 years, which you are going to issue that bond for 3 years, and then maybe you solve the problem in the second year. You can choose to call the call option, and then you pay people their money back.
We paid people their money back. That is when you are done with whatever you wanted to do. Okay, thank you. But more importantly, we know that as for businesses, they never get to a point where they didn't need any money. So there could be something else that is profiting them. It's like giving you back your money will be profitable to them. What would that be? You invested in Ghana government bond for 5 years. Then after 3 years, because there was an embedded option for a call, they announced that all bondholders should, come for their money. What do you think will make a government or an institution make that move? Apart from the fact that perhaps they are done with whatever they are doing. If we use the government as a case in point, we know that even if they took it for a project and they are done, they would still have other projects they could have, gone into with that money. So what is it that benefits them so much that they want to call back the bond? It's like, come for your money.
Hello, madam.
Yes.
I'm thinking that when they have alternative sources of raising funds at a lower cost, they might put that.
So the word is at a lower cost. At a lower cost. And it could even be still floating bonds, still giving out bonds. But when interest rates come down, let's say that bond was at a coupon rate of 10%. And generally, interest rates have fallen so that there are bonds that are going for 5% coupon rate and people are buying. If there's a call provision, then this issuer will say that if we don't call back our bonds, we would be losing because there are 5% bonds in town and people are buying. So they'll call and give you back your money and then resell or refloat bonds for 5% and people will buy because interest rates have come down. The bond they are holding is expensive, so they would have to let it go. That's one of the reasons why there is that option, and it benefits the issuer by allowing them to replace outstanding bonds with high bond issues or interest for lower coupon rates. Okay, it gives them the opportunity. So once there's a call provision, it allows them to beat down the cost of holding that bond with you. Likewise is the put. Yes, I see Ture, if I'm pronouncing it well. Your hand.
Yes. I have a one question to ask, please.
Okay.
Yes. Could you please explain how the coupon rate affect the return on a bond?
If I'm holding your bond for
Yes.
10 years and I'm paying you a coupon rate of 10% every six months. If I'm paying you 10% every 6 months and interest rates have come down really good, and there are other bonds in town that are going for 5%. 5%. So it's like I'm holding 10. Our 10% becomes the most expensive in town. If I give you back your if I call back the bond in 5 years or in 3 years, I would have paid you coupon for just the time I've kept the bond.
Okay.
Yes. And so it's one of the risks that bondholders face. Once there's that call provision, you will definitely not have the value you would have had if you had kept the bond for 10 years, paying the same coupon rate. Is it clear?
Yes.
Yes.
Thank you.
Thank you. All right. And so we also have the put provision that allows the investor to also, say that, my bond is 10%. These days, the bonds in town, they're 13 and 15. So once there's a put provision, they will tell you to give us back our money. They activate that put provision. So it gives the bondholder the right to sell the bond back to the issuer at the par value that was agreed on. And then they can also buy other bonds in town that have higher yields. I see 2 hands, but I can't see participants. So if there's an old hand, lower it so that we can know who is, or just come up and let's see. Let me hear you.
Hello, Doc.
Yeah.
Doc, so please, I want to ask if in the call option and the put option, is it that easy to go about? Because the issuer is making use of your money. Maybe they have invested into a business or something, and then you come and then you demand for your money because there is a high interest in the market. Is it that easy?
That is why before the contract or in this decision or in the institution of the contract, once the issuer agrees on a put provision, the issuer stands the risk of losing that money, even when the duration or the maturity is not due. So once it's like you went for money from a friend, and the contract you signed with the friend was that I'm taking it for 3 years. But if you need your money in 2 years or in a year or whatever time you need your money, when you call for the money, I will bring it to you. So I'm giving you my money, but I will need the money. I just don't know when I'll need the money. If I need the money, I'll come back for it. Then you agree, we sign, you take the money and you are doing business with it. In that agreement, you said whenever I need the money, I should come back for it. So when I call for my money, you would have to give it to me. So it is a risk that the issuer also bears. Likewise, it is a risk that the investor also bears if it is a call provision. If it's a put provision, then the issuer also bears that risk of losing the money within that time frame that he's holding the money and has agreed that you have the opportunity to, call and say that you want your money back. So it is a risk, and both of them bear that risk agreeably. That is why it's not every bond that has that provision, that embedded option.
Okay, thank you.
You're welcome.
No.
Yes.
My question is from your understanding of the bond market.
Yeah.
If these two conditions, let's say the core provision and the put provisions, were embedded in the bonds that the government raised, which suffered the DDEP, how would this have affected those who purchased the bond and also the issuer?
Okay, so you are talking of the haircuts?
Yes, please.
Okay, so in our case, if there was a put provision, then you are trying to say that people will ask for their money back. But you see, we're in a crisis situation and we didn't even have the money to pay you your interest, let alone to give you your whole money back. You get it? That is why in our kind of economy, we do not, have embedded options of a call provision. Usually in a more stable market, in a more stable economy where they have enough, they have that kind of option. That is like the money is not tied to nothing in particular. It's like you put your money in the bank and you can go for it at any time. That is how it works. When you are going for your money at the bank, you don't need you don't follow any timelines. I just need the money, I go for it. Okay, that's how it works. In some economies, they have the call or put provision that allows you, if it's put, to just come for your money back when you need it, because they understand that you have made an investment, yes, but if you are in crisis, you will need your money. That economy is more stable. Our economy is not that stable. So we are using your money as an investment somewhere. Once we take it, it is gone. That is why we don't have that embedded option. If we had that embedded option in our bonds at the time of the haircut, it would have been disastrous, because people will not be asking for just their interest or their coupon. They'll be calling for their full sum of the money. And that will be a total collapse of the economy. So yes, it is a risk that both parties bear, depending on whether it's a call or a put provision. But it's usually rolled out by more stable economies that have enough. So you cannot, your put provision doesn't cripple their system. Makes it more flexible. Any other question?
Hello, madam.
Yes.
So, with this call and push provision,
Yeah.
at any point in time, these provisions can be put in place.
Yes.
When you have the embedded option in the contract.
Yes.
Okay. What if
the embedded option is spelled out, whether it is a call or a put or both. So it is an embedded option of a call provision or an embedded option of a put provision or both.
Okay, so let's say not you, the issuer, the receiver.
Yeah.
Asks you to come for no. You, the issuer, want
the
your
issuer,
bonds back.
the
Yes, you
company,
want it.
yes.
Yes, you want it back. And at the point that you want it back, the holder cannot give it back to you. What happens?
Wait, let's spell it out well. The issuer is the borrower. Let's use the government to make it clearer. So government
So
of Ghana,
I am the issuer giving it to the government.
You are the you are not the issuer. You are the bond
I
holder.
am the borrower. Very good.
You
So
are
I
the
am
bond
the
holder.
borrower. I give
Yes.
it to the government. And
Yes.
at a point, because of this embedded option, I need
Yes.
my money.
Yes.
And as of the time I put in the request, what if
Yes.
the government, as of that time, doesn't have the fund to give me?
That is why I said it's usually done in more stable economies that have money. Let me use the US government, for example. If the US government has enough money to be borrowing to African countries, if they have a put provision in their bond, your put provision, the time at the point where you say, I need my money, you cannot affect their economy. It's like they cannot say that they will never say that they don't have the money to give you. They have the money enough and they're giving it out. They're giving some out to other countries on loan. Do you get it?
Yes.
It's like you're a home manager. You are the home manager. You have money that you use to manage your home. And you have a friend who is asking for some money to do business, or me watch me. Give me, sorry, Sure, you are here. I should go back to speaking English. Okay, so I'm hard up. Your friend calls and say I'm hard up. I need about 1,000 Ghana cedis to do something small. I'll give it to you in a month. You would give, if you have the money, you will give your friend that 1,000 Ghana cedis, not wiping out all the money in the house. So that is how that government works. They are giving African countries money, not wiping out. It's not like they are on ground zero at the point where they are giving out the money. So they still have money. So that if you call, if you put in your put provision to collect your money back, that wouldn't cripple their economy. They will have enough to give back to you. And remember that the interest, the coupon rate they are given is so good. If you are really calling back or using your put provision, you really would need the money. That is why. Otherwise, you would just want it to be there so that you enjoy the coupon that keeps coming from it. Like in our case, you see that a lot of retired people were affected because they were receiving periodic money every 6 months. Government pays coupon every 6 months. Government pay coupon. Some of them, that was what they were living on. Some of them, that was their hospital management, money and all that. So if one of them decided that we have a put provision, so I am calling, give me back my money, the person must really be at a dying point of needing the money to take it. It won't just be for luxury. Okay, so my point is to say that not everybody holding the bond will put in that put provision at the same time so that it cripples the economy. So it is usually done by economies that have very stable finances. Yes, I see another hand. Please, when you raise your hand and you finish asking your question or making your input, then you lower your hand because then I'm not able to see who to call. So yes, if
Yes,
you,
please, it's me.
yes, Ima.
So yes, please. So please, I want to know, in the worst case, when there is a default in this embedded option, in the worst case, what will happen or what can happen?
Please hold on a bit. I didn't get you,
Okay.
but I'm distracted. Sorry, ask your question again.
Okay, please. So please, I'm asking that in the worst case, when
Yes.
there is a default, any of these provisions, when there is default, what can happen in the worst case?
In the worst case,
Yes.
I don't think they will give a haircut. I think they will delay your payments. In a worst case, that's what may happen because they cannot reduce your principal.
Okay.
Yes, so in the worst case, you are calling for the money and they are saying that we don't have it yet. That is the worst case. But usually when and even this puts provision doesn't happen with corporate bonds. They are usually government bonds and government bonds from very stable economies. And it's unfortunate that now we have to make that differentiation because we have had a failed, you know, we have had a risk with our Ghanaian bonds. Okay, it's as I'm saying it. When I go to say stable economy, it's yes, Derek, I'm coming. It makes me uncomfortable to feel that our economy is not stable. But yes, that's the reality on the ground. That's African economy. So people who invest with Africa invest with a lot of risks. And that's why they also demand a very high interest or very high coupon because it could be one disagreement between two parties and the whole country is in chaos. And then your money is locked up, you see. So before you make a such investment, you are studying all these, what the economy is looking like, what their political weather is looking like. And if you've observed towards the end of a government tenure, when we are going to have elections, you will see a lot of companies pull their resources out of Ghana. A lot of investors just pull their resources out of Ghana. A lot of foreign banks carry their thing, like if they have money and stuff, they just move because they don't know what is going to happen after the election, so that they are not at a loss. Yes, please, somebody raised his hand. Is it Martin?
No,
Okay.
Okay,
Yes.
so I want to find out, just trying to link. So can we say the core provision put on the bond favors the issuer, and then the put provision put on the bond favors the borrower?
Exactly. The
Okay.
put provision favors the borrower when interest rates go high. When interest rates go high, then the put provision can be activated by the borrower so that he will collect his money and then buy another bond with a higher interest rate. The call provisions favor the issuer when interest rates have generally gone down so that he can also just call back the bonds, pay people their money, and then reissue new bonds at lower interest rates. Is it clear?
Yeah.
Yes. Any other question? Okay. So then we move on to the convertible bond. Convertible, to convert your bond into something else. So convertible provides the holder the right to exchange bonds for shares. To exchange bonds for shares or common shares. It allows the holder to take advantage of favorable movement in prices of issues of common shares. Then we have exchangeable. Allows the bondholder to exchange the issue for a specific number of common shares of a corporation different from the issuer. So let's say if we have an embedded option of an exchangeable bond, you could, and your bond is a government bond, you could convert portions of your bond into shares of MTN or the other one that's doing well is Fan Milk, to Fan Milk or to MTN shares, because you see that the returns from that side is also looking very good. But remember that shares are very risky. It is not a definite win. You could have shares rising up high, and then by next morning, shares have fallen, and your share price is just going down, 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 down the drain. So exchangeable, you can exchange from your bond to another for shares of another company. Convertible, you are just converting from the same company bond to common shares. Okay. Okay, so we go to the almighty risks associated with investing in bonds. So that if we thought that bonds were not risky, they are. It's just that there's a pyramid. Let me say there's a pyramid with which you would work. If you are looking at a pyramid between bonds, shares, and treasury bill, yes, these three, bonds, shares, and treasury bill, how would you rate them? Which one will be of the highest risks? Which one will have a minimal risk? And which one will have the lowest risks? Which one of them will have a high risk? Which one will you say has minimal risks? And which one will you say has the lowest risk? Between bonds, shares, and treasury bills. Any ideas?
Hello, madam.
Yeah.
I am thinking that shares are more or less having a higher rates compared to bonds and that of treasury bill.
Okay, so shares will be your first on top for risks.
Yes, followed by the bonds, and the last one will be the treasury bill. Even that one, we know it doesn't have any risks attached.
It doesn't carry any risks attached to it because you collect your money before you even invest it.
Yeah.
Yeah, so that one has minimal, little, small risks. Okay. So let's go into the risks associated. We have the interest rate risks, reinvestment risks, call risks, credit risks, inflation risks, exchange rate risks, liquidity risks, volatility risks, and risks. That one is very funny. Risks. Okay. If anybody has had interest rate risks before, what would that mean? Yes, someone, you want to try?
So I think that's a question.
Yeah, you know.
Okay, so if I may, would that mean the rise?
Hold on. There's someone whose mic. Please, if your microphone is on and you're not talking to me, kindly lower it. Mute it for us. Veronica. Thank you. Please, let's go on. Thank you very much. Yes, please come.
So I was just suggesting that the interest rate risks would be the rise and fall in interest rates. So maybe the economy might not be doing well, and interest rates might be high. And if there's a turnaround in the economy and interest rates are low, that is when you can face such a risk.
Yes, thank you. So yes, it is the rise and fall, the fluctuation in interest rates. It is the risks that bonds face, or the risk of a bond that the price will fall due to rising interest. When we say the price of a bond will fall due to rising interest, what does that mean? The price of a bond will fall due to rising interest.
Okay. Could it mean that the interest rate that the bond was issued at is what is going to be affected?
Yes, my question was, when we say the price of a bond will fall, due to rising interest. What does it mean? Okay, so we know that bonds have prices, okay, and then they're affected by interest rates. And so if, let's say, interest rates rise and new bonds pay higher coupons, if interest rates begin to rise up, let's say the existing bond, government bond is, no, if I say government bond and corporate bond, that's risk. So I will not compare the two. You are buying, you are holding a bond, or you are floating a bond. You are the issuer, and you are issuing a bond with an interest rate of 5%. And then people are investing in bit by bit. Then over some time, let's say in 3 weeks, there comes a bond with higher interest rates. Both of you have the same risks. Let's say two corporations, both of you can disappoint us. So we agree that you are on the same scale when it comes to risks. But company A is giving 8 bonds out at 5%. Company B is giving 8 bonds out at 10%. You have bought company A already. You wish you could sell your bond out and go for company B. You see that the price of your bond, to be able to sell your bond, you will have to beat down the price to be able to sell your bond, because you are not looking attractive anymore due to interest rates that are going up. So one of the risks that usually bondholders will face is that they made an investment at an interest rate, and then later interest rates have gone very high and they are stuck in the already existing one that they have done. It's a risk to you because you're a business person. If you gave out money on an investment, it's business that you're doing. You intend to earn from it. So we call that interest rate risk. Interest, just like interest rates can go up and down, the fluctuation of interest rates is what results in interest rate risk. Then we have let me ask, there any question from there?
Okay, let me ask. Okay, so with the current cobalt issue, we are hearing government wants to raise domestic bonds.
Okay.
Now, in them raising domestic bonds in this ever low inflation rate as well as low interest rates, which has to do with the 91-day, 182-day, and 364-day.
Mm-hmm.
What do you think would the government would do if they issue the bonds? Would they issue it at a high interest rate, or they're going to do that at a low interest rate?
The government will look at your perception first. The government will look at your perception first and will put himself in your shoes. How is this person seeing us? And how is this person seeing the two bonds, the risks attached? Okay. If we believe that the government or the economy is more stable, and we will not wake up tomorrow morning hearing stories of we're not able to do this, we're not able to do that, and then automatically things begin to shoot up again. If we have that trust, and if the government believes that we have that trust, then you see that they'll be offering it at a very competitive rate. A very competitive rate, because they want you to buy. If they are floating two bonds, they will look at the risks involved in the two, and the higher the risks, the higher the return. The lower the risk, the lower the return, and that's how it plays out. Is it clear?
Yeah, it is. So
Yeah.
most likely to raise it, they might give a higher interest.
Yes.
So people can afford, so that they can get this.
Exactly. Yeah. Okay. Then we have what we call the reinvestment risks. Reinvestment risks with the name, as the name goes, reinvestment risks. Who can tell us what it may mean or what it signals? Reinvestment risks. Anybody? If you say you are reinvesting something and there's a risk in reinvestment, what would that mean?
Hello, madam.
Yes.
The risk of reinvesting at a lower rate compared to what you were earning earlier.
Yes. The risk of reinvesting at a lower rate compared to what you were earning earlier. Okay, another view. Someone wanted to talk before I come in.
Could you also compare that to what happened in Ghana, the DDE?
Let's see.
Oh, as in the bonds were issued, yet when the DDE happened, they had to reinvest it at a longer term rather than what was intended.
Yeah, so this one seeks to talk about how your capital is lowered or the value of your capital comes down at the point where you want to reinvest. Okay, so if there's inflation in the system, or you did an investment earlier, like she said, and then you have received your interest on the investment that you took, and you want to reinvest, and interest rates have gone down. You see, when interest rates go down, it's good for the economy, but it's bad for the investor because investors are looking for higher returns. So if you are going to do a reinvestment and interest rates have gone down, you're at a risk of earning lower than you would have earned before. Do you get it? Is it
Yes.
clear? It's clear.
Yeah, it is.
Yes. So you want to reinvest, but at the point where you are trying to reinvest, the risks, interest rates have gone down, and then you bear a risk on that. You bear a risk for having to hold, Then we have a call risk. You have a call risk. What could that be?
Madam, could it be that maybe an agreed interest rate can be reduced when you call your bond?
Again, come again.
I was saying that can it be said that when the bond matures at a specific date, and then you call back the bond, I mean the interest will be reduced as compared to when you allow it to mature. That's what they call the call risk.
So when the issuer has called back the bonds with your high interest, yes, with your high interest, and then gives you back your money, and you are going to reinvest it at a lower interest rate. So investors, from the investor perspective, there are three disadvantages of a call provision, or there are three risks. First is that the cash flow pattern on a callable bond is unknown, so that if I was investing in a bond that has a call provision, and I gauged myself that I was going to use that money from that to finance something, maybe finance my child's school fees or building projects. Every 6 months, I get a certain money from that bond to finance the project. Once there's a call provision, I cannot certainly say that I will be receiving this coupon over the period of time I have made that investment, because there are chances that they could call it back and I lose that cash flow that keeps coming. So in the case of a pensioner, if that is what the person is living on, they say that every 6 months the person gets something from that bond. And if it's a callable bond, then there's a risk factor that you would not certainly have. Maybe you've saved it for 10 years. You made that investment for 10 years. You, in your hope that for the next 10 years, I don't have to worry about money because I'll be getting every 6 months this amount of money coming in, and I'll use that to manage my life. With a core provision, you stand the risk of not knowing the certainty of receiving that coupon over the 10 years. It could end in 4 or 5 or 6 years once the call provision is implemented. Secondly, because the issuer will call the bond when interests have dropped, the investor is exposed to reinvestment risks. So for the call risk, you have an uncertainty of receiving your money, the coupon as scheduled every time. 2, you are at a risk of reinvestment, because if the call provision is effected, it means that we give you back your principal and you are going to reinvest in a lower yielding bond, which also affects what you are getting every 6 months. So you are exposed to that reinvestment risk. Do we get it?
Yes, madam.
Yes. So for the call, you have the risk of not knowing whether you are going to be getting the money all the time, and then the risk of even investing that amount of money. Reinvesting that amount of money. Then we have credit risks. Typically, yes, there are. I think somebody can tell me something about credit risks before I shoot. So, any idea on credit risks? I like it when you make your contribution because you seem to put it in a very simple way that your colleagues will understand. So when I say contribution, please contribute. There's no wrong answer. We are here to learn and we manage. If you don't say it, you don't even know that your answer is wrong, you see. So credit risks. No volunteer. Okay, let me go. So credit risks. That's why if you apply it to the banking system, if you apply it to loans, then you'll be able to get it very clearly. So credit risks. It is the risk that the bond investor will suffer. He will suffer a loss of credit risks. That is that the person who took or floated the bonds will not be able to pay the interest as required. That the issuer is not credit worthy. If the issuer is not credit worthy, then you suffer a loss of not receiving your principal at the scheduled time, of not receiving your coupon or interest portion at the scheduled time. And that is exactly what happened in our case. Credit risk. Credit risk is very high for corporate bonds and lower for government bonds. Okay. And under credit risk, you would suffer a default risk, a credit spread, or a downgrading. of your bond. So the bondholder, the investor, will suffer a risk of not receiving their investment as agreed. Example is the haircut. And we all remember this incident very clearly. So this is where Ghana was placed. This is the issue Ghana had. Our inability to pay coupons as scheduled, and our inability to even pay the principal at the end of the period that we had agreed, to the point where we were going to extend, the coupon, the principal payments, extend the maturity date for principal payments. So under credit risks, we have the default risks, which is the risk that the bond issuer fails to meet the contractual agreement, the contract between the two, missing out on interest payments, or failing to repay principal at maturity, or forcing a restructuring.
You're going very fast.
I'm going fast. Enim, is that you? Enim?
No, it's Dinah.
Dinah. Okay, I saw Enim. Enim, your hand was up.
Madam. Yeah, madam. I wanted to ask this on explanation on the credit risk. If I got it right, you were saying that maybe not paying your principal, both your principal or interest at an agreed date or agreed rate.
Yeah.
But madam, if maybe let's say the issuer of the bond or the borrower, maybe I want to assume as I am the borrower.
Yes.
And then maybe I'll pay the agreed amount of interest and then the capital, but not on the agreed date. I'm also very rich.
Yes. That falls under default risks, which is a component of credit risks. So I'm trying to slow down. So that is a default risk. So I said that a credit risk is a risk that you bear, that your issuer is not credit worthy. Not credit worthy in which sense? Not credit worthy in the sense that there will be a default risk. He's defaulting in paying your interest payments, or he's defaulting in paying the principal at maturity. So that if your bond is a 7-year bond, and because of credit or financial issues, you extend the bond to 10 years. The issuer extend the bond to 10 years. So 7 years is the maturity date for the bondholder. But by the time of maturity, you say, I am extending your bond to 10 years. That will be a default risk, which is part of credit risk, which falls under credit risk. So in credit risk, there's a default that the person will not pay coupon as agreed, will not even pay it on time, or the person is failing to pay at maturity, and now extending your maturity date. Because we also know that the money is not just there. You invested the money for 10 years, knowing that you invested the money for 7 years, knowing that after 7 years, your son would have entered the university. Once you collect that money, your principal, it will sort your son's university bills out. So you have, closed your mind on that. You have rested your head. You have lived your life. And after 7 years, your son is entering the university. And then this bond holder or issuer decides that I won't be able to pay your money at this time. I'll pay in the next 3 years. That distracts your life. and that is a default risk that falls under credit risk. Okay. Any question on that? Yes.
But I want to ask, so when the person defaults, like he's supposed to pay the thing in 7 years and has ended up to 10 years, that different 3 years, are you going to add additional interest or is going to pay the old interest that you agreed on?
It's going to continue paying you the coupon. So you would have received coupon for 7 years, but then he has extended your coupon. So you still be receiving coupons till the 10th year. That's how it should work.
Okay. Very well.
Because he still has your money. So the disadvantage is for people who didn't need the money. That wouldn't be a problem. It means that they have extended the period. But for people who had a plan, then that, yes, their plan is
distract
still
them.
distract them. Remember also that you are also at a disadvantage if interest rates
drops
higher. Yes. No, when interest rates have gone up and your 7 years bond that should have matured is still with the issuer paying, let's say, 7% from the time you agreed on it, and then now interest rates are at 10%, but he's not able to pay. He's unable to increase the interest rates because the agreement has already been. Yes, so you lose on that because you could have been invested.
Exactly.
Yes,
Thank you.
could be invested, so you lose on that. Yeah.
Hello, madam.
Yes.
So can we say the DDP is an example of a credit risk?
Yes, and that's your assignment for this week. That would be, I'm going to give you an assignment for this week pertaining to Ghana's experience on the bond that we had. And I pray that you will not go and tell ChatGPT to do the work for you, because I will see it. I will see it. If you submit ChatGPT, I will see it. I have if you use a humanizer, I'll still see it because I have my Turnitin in here. Once I run it through my Turnitin, it will tell me that yes, similarity index is there. Then AI generation will also be there. So please, 5% minimal AI generation, 5%.
Okay.
We'll put the question on the school learning platform for you.
Very well. Okay.
Yes. I'm happy we have this experience from Ghana so that we can go probe into it further and understand what exactly happened and what, if you are investing in a bond, what you should look out for before you invest in the bond. That will give us a lot of guide over there. Okay. So we are done with yes.
So then,
Yes,
so the banks are lying to us, if I can put it down. Why am I saying that? But when you walk into the bank, I'm saying that it means that the banks are really lying to us. Why am I saying that? Because when you walk into the bank and you say you ask them to advise you on any investment, maybe portfolio or whatever you call it, any investment, so just straight away tell the bonds are the most less risky. So with this, what
they are not lying to it. They didn't say it is without risks. They said it is less risky. It's not. They didn't say it is without from your statement. They will say it is less risky. If you are looking at no risks, then you go to Treasury.
Okay.
Yeah.
Welcome. Thank you.
Okay.
Hey, madam, please, sorry, but my last question, I'm not the list. So the credit risk.
Yeah.
I wanted to ask, maybe when the time is due, that I agree to pay, and then the borrower or the issuer is not able to pay, maybe on the agreement, and maybe the borrower to pay was a percentage of the agreed amount. What can also pretend that is still a credit risk. Borrower.
Yes, because the borrower expected. So you said the issuer is able to pay a percentage.
80%, yes, but not the 100%, like a percentage of the agreed.
Yes. It is also a risk because the agreement is that, and I don't think that the borrower, the investor ever had it in mind that at the point where they are calling for, at the point of maturity, the issuer would not be able to pay in full, because for bonds we know that ideally what is supposed to happen is I go into investment in a bond. If it's 5 years, at the end of 5 years, I'm collecting my money back. That is so from the initial stages that the person is making that investment, that's the mindset. So if after maturity, you are paying a percentage of the money, that is disappointing, and that is a risk. That is disappointing, and that is a risk. You will be able to value the risks more when you are looking at the alternatives that the person would have used the money for, or what really the person is using. Let me use the Ghana case, for example. When people's medical bills were tied to that money, people were on dialysis, people were on medications that every day they have to take, and they are very expensive medicines that were not covered by NHIS. And with our economy, we know how it is. I'm sure some of us have children, and we have parents in the system. So your mother is alive, or your father is alive, or both parents are alive, and you have to take care of yourself, take care of your children, and take care of your parents. You know how that hurdle can be. So that if your mother or your father is relying on that money to sustain their life, and then at the point where the money has to come, they say that we can't pay all, we can pay just half. You see how disappointing it will be. And the risks of even losing your parent based on the fact that you cannot manage the expenditure that comes with the person. So it is risks, but the level of risk is only understood by the investor based on what they were going to use the money for. If the money is just lying there and you don't need it, you will not even worry. You just, at this point, they are very disappointed. They should have given us our money. Then you just brush it off. But if you were going to use that money for something, like I said, you were going to use that money to pay your child's university bills. Your child gets admission into Laing for medical school. Medical school is about, if I'm not lying, 15,000 every year. Unfortunate for you, if you get a private university, every semester you pay that amount of money, and then you were hoping to get your bonds, principal to sort you out and give him a very good landing. As he's landing in school, his laptop is ready, his hostels are done, his blah 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 is paid, and then your issuer says that I can give you only 50% of the money. You see the risks there. So even if it is 90% they give and they didn't pay the 10, you still have that risk featured there. They still have that risk featured there. Once they can't go by the agreement that they made, then there's credit risks. Then there's credit risks. Okay. Yes, there are a question or a comment. Okay, let me read. Please, would you advise anyone who wants to buy a bond go ahead in Ghana? And what are some of the things to look out for in the economy? Oh, this one is a homework, so I won't answer it. The second part of the question, it's your homework. So I won't answer that one. Next week when we meet, then we'll answer that question. But I think that we cannot give up on the economy because one time something happened. I think that I won't also say that it was deliberate. I won't say that it was deliberate. I think that something really went wrong. Whatever it is, I cannot tell because I am not there. I can't say it was mismanagement of funds, it was loot and, chop. No, I can't. But I don't think that we should give up on our economy. There are a lot of things that come to play when you are dealing with the economy. People are saying this government is doing well, this government is doing well. Others are saying they are not doing projects, they are not doing capital investment. That is why we think the economy is. So you see, somebody is trying to stabilize so that we can jump from a stable position. Others are saying, you are not doing anything. We can't see any investment here and there. But we've forgotten that we're not stable at the first place. So we cannot give up on our economy. I would say, yes, invest in bonds. But if you see, diversify, rather, let me say, diversify your investments. Diversify your investment. You have some in obviously mismanagement of funds. Me pacho, why? Me pacho. So diversify. You buy bonds, you buy shares from very,
Like
very good
treasurables.
companies. Yes, very, very good companies that are doing well. And then you buy even treasury bill and diversify. Don't put all your eggs in one basket. Go for some foreign bonds. Go for some foreign bonds. Go for some foreign shares. Like mix it. Adiano, sorry, two-way, sorry. Have a mix of the investment so that you will not, go into chaos. When you read a bit of corporate finance, it teaches us to diversify, spread, your investment so that you are not looking in a can. We say you are not looking, yeah, we don't use two eyes to look in one bottle. You see, you can't see inside. So I don't know if I'm using it right. You have to look at other ways of making money. Even running a small business that can give you daily inflow. So you are investing in bonds. You have your own small business that is running on the corner, giving you daily inflows. And then you have bought some MTN shares. You have bought shares from, is it Google or Tesla? You have bought some shares from somewhere, and then you are just also reaping something from there, knowing that shares are more risky. You have some treasury bills. That one is stable. It doesn't move. Money that you want to go and take later and not have issues with it. Treasury bill is just sitting there quietly for you. Yeah. That would be my advice. So we shouldn't give up on our economy. This is where we are. If we don't invest in it, who should come and invest in it? If we don't believe in it, why would an outsider believe in it and come and invest? It will cripple the economy. So yes, I would say that it is just one time that the government has failed us in all our 60-something years. So let's not take it too hard. It will get better. Okay. Then our next after credit is inflation. Inflation. And this one is the normal inflation that we know. So how does inflation risks apply when it comes to bonds? How would you explain that?
Hello, Doc.
Yes.
Okay. Regarding the inflation risk,
Yes.
I would say it stands to erode the purchasing power of a potential investor due to the persistent rise in the price of goods and services. That would
Yes.
affect the return on the investor's investment.
Yes. So You made an investment, you are receiving your coupons, and you receive your principal at a certain time. But when inflations keep going high, you realize that the money you have, the money you are going to receive from either coupon or principal will not be able to do as much as it would have in maybe a year or two before. If let's say you were receiving 500 Ghana cedis coupon, say 6 months. So let's say you are receiving about 5,000 every 6 months, and 5,000 can maybe a year or two before, 5,000 could have bought you what? What could we have used 5,000 to buy? Maybe start a momo. Maybe you wanted to,
maybe a motorbike.
What? A motorbike, eh?
Yes.
Hey,
Yes.
buy.
It can buy, eh? Mercy. It can buy. Let's say home access. Let's say you wanted to buy a laptop, and 5,000 2 years ago would have bought you a laptop. I'm not saying 2 years that's in Ghana or 2 years. Hypothetically, I'm saying that you had 5,000 every 6 months, and you have decided that this 5,000, the next one that is coming there, I'll use it to buy a laptop. Let's say 5,000 would have bought a laptop a year ago with a very good spec, and because of inflation, prices have started shooting up. When you receive your next 5,000, you realize that it cannot buy the laptop you wanted to buy. Due to inflation, price of goods have gone up, so that the capital or the value of the money you are holding have fallen. So there's that fall in value, purchasing power. Your purchasing power is now at risk, such that it doesn't have enough power to buy what it would have bought about a year ago. Same thing. So that will be the inflation rate. You receive the money, all right, but it cannot do what it should have been able to do a year or two ago. And that is inflation rate. So if you receive your money and there's a lot of inflation, then you realize that you can't even use it for anything much. That's inflation. That one happens with our salaries and our pocket money. We are able to see how it affects our pockets. It's the same thing. So you receive the money, but you can't use it for so much. That's inflation. Then we have exchange rate risks. Exchange rate risks. Who can give us an idea? Exchange rate risks. Exchange rates.
Hello, madam.
Yes.
So just like the inflation.
Yes.
So if you have the exchange rates rising, that one too will cost your returns to fall, because Ghana is an import-driven economy.
Okay.
So most of the things we buy here is imported. So when you have the prices of goods and services going up as a result of the exchange rate, so it's just like the inflation. You ask me, yes.
Okay.
So
Any other?
your money, though your money worth will not be the same as the money worth will come down because of the change in exchange rate. Because as you said, maybe in let's say 2 years ago, if you can use 5,000, maybe you have a friend in the US coming down, so I have 5,000, so I want to change it. How much is laptop? Let's say 1 CD to 1 CD. So he said $5,000. Okay, then I'll give you my 5,000 to buy the laptop for me. And now let's say the CD is 2 CDs. It means you need twice that amount to buy the same commodity.
Yeah. Thank you very much. Your explanation is spot on. In fact, the second phase of your explanation is spot on. So it's the exchange rates affects the value of the money that you have. So that is exchange. Let's say you said you wanted to buy something outside the country, and then because of our exchange rate, now that becomes a problem. You need more. Likewise, it is for us, for somebody who invests in Ghana and the person lives abroad and he's promised his value is in Ghana city. When let's say the person Kwame lives abroad, Kwame says, I love my country, I have money, I will invest in my country. And so Kwame buys bonds in Ghana. And then he receives his principal or his coupon in Ghana cedis. At the time where interest rates, exchange rates have gone very high, 1 to 14, 1 to 15, you realize that when he converts his Ghana cedis into dollars, it will become small as compared to if it was 1 to 1. If he receives 5,000 Ghana cedis, it will be $5,000 1 to 1. But if he receives 5,000 Ghana cedis and he's converting it into dollar at 14 cedis, at 15 cedis, you see that the value of the money he's having just drastically falls. And that is a lot of risks for people who live abroad and invest in other countries whose currencies are denominated in their currency but not in the dollar. And that becomes a problem. Yeah, that becomes a problem. Thank you very much for that explanation. Then we go to liquidity risks. What is liquidity? Before we come to the risks of it, what is if we say the government is having a liquidity problem, or a company is having a liquidity problem, or a home manager is having liquidity problem, what does it mean?
No cash.
No cash. No cash. There's no money. Okay, so now let's translate that into bonds.
Hello, madam.
Yes.
Yeah, so with this type of risk, the bondholder ready cash.
Again, come again. I lost you there.
Yeah, so I'm saying that with this type of risk, the bondholder is unable to sell
yes
quickly or easily to get ready cash.
Yes, the bondholder is unable to sell easily. That means that the bond the person is holding is not liquid. It's not liquid. What's the other word to say? It can't just flow. It's not liquid. So you are unable to sell the bond you are holding, maybe because of a downgrade, maybe because of maybe this that your issuer is not trustworthy. It's like a lot of things are affecting your ability to sell the bond. People don't want to buy because maybe the coupon rate is low, interest rates have gone high, or your bond issuer is not credit worthy, so we don't want to buy your bond. Imagine that at the point where we're doing haircuts, somebody wanted to sell his bond to another holder. Do you think anybody would have bought? Yes, so that made our bonds illiquid. It wasn't liquid enough. So people couldn't just sell it off. It's not possible. So that explanation was good. Thank you very much. And then if I'm going too fast again, please, you let me know. Volatility risks. Volatility. The thing is volatile. Volatility risks. Anybody? Okay, so it is just as volatility is. It is a risk that a bond's market price fluctuates significantly over time due to changes in interest rates, credit conditions, inflations, and market sentiment. So a lot of things is making that bond volatile. You cannot, it is not making the bond attractive. Yes, so there's interest rate volatility, unexpected changes in interest rates. It can come to volatility, inflation, uncertainties, credit risks. It's just the thing you are holding is volatile. That's how to, if there's another word. Who can give me another word for volatile or volatility? I want to explain it in a layman's English. The variation, there's so much variation in price, in the market conditions for the bond that you are holding, and doesn't make the bond attractive. As for risks is the risk of the unknown. Not knowing how secure your bond is. That is risks. The risk of the unknown. That is risks. And so I've done the explanations here. Somebody said something. Unstable, yes. Thank you. Volatile, unstable. Okay. So the explanations are all down here. I didn't want to read. I wanted to discuss. So we've discussed them and then they are all here. When I send the slides to you, you have all of that over there. Okay. So this brings us to the end of the first section on bonds. Yes. Emmanuel Kweku. Yeah. I think that I have 2 or 3 Emmanuels here. So I have to add the this one is answer. So answer. Answer.
Hello?
Yes.
Yes,
Yes.
yes, yes. Hey, madam, about the volatility, the last part of
Yes.
liquidity and then the figures you were saying.
Yes. Is there a question? I can't get you very well. I can't get you very well. Are you still there? Answer.
Network issues.
Okay. So I get a question here. How do you invest in another country? This is a question. In fact, one of the things we wanted to do was to bring a resource person to take us through the practicalities on the ground, the nitty-gritties on the ground, so that we've done theory, but then we'll do practicals. Practicals, no, you will make investment to 100 Ghana cedis, 200 Ghana cedis, 500 Ghana. What do you think? You buy treasury bill. He will teach us the practicalities. Then you go and practice it and come and tell us how your practice went. What do you think? It's a good idea.
It's a good idea.
It's a good idea. It's a good idea. But some of us have not made any investment anywhere before. So we'll bring a resource person to come and talk to us. And then, yes, thank you very much. Abaka Boateng, if I'm mentioning your is Dinah. Is it? No, that's Dina. Is the name Dina?
It's Dinah.
Depending on the school I attended. D-I. Yes, what's the name? What's I see
It's
D-I?
Dinah.
It's Dinah, but you didn't bring the A.
The one in the
Who
Bible.
one is Diana?
This one is, so we didn't go to good school. We are saying
Exactly,
that.
exactly. The LA and the ME.
Thank you very much. Yes, so I'm working, we are working on it to get us a resource person who will take us through the on the ground. If I want to do an investment in the foreign country, what are the procedures? What do I have to look out for? If we want to do an investment in Ghana, in MTN, in that, I know that you know the MTN ones, but this exercise is supposed to help us get a taste of it. So we'll practically go and follow what the person told us, do it, and then have a feel of it that you made an investment somewhere and it has yielded, even if it's yielded 50 Ghana cedis, your money would have been gone if you are not invested it. You would have spent it in a year, you'd have spent it without remembering you ever had that money. So we'll practically try and do the investment and see as little as you can do. So we'll bring the resource person in. We have some time. I got a call from your class rep. Next week we are supposed to have face to face, but I think one of your lecturers is not available, so we are moving it. So that would have been what we wanted to do, to bring the resource person in person to come and talk to us. So we'll see how that arrangement will go. Perhaps we'll do online and then we can ask all the questions we want to ask. Then we'll do the face-to-face at the end of the is it 6 weeks we have? We'll do, yes, the last week to revision.
Yes.
Then we'll do face to face. I think that it will be good. By then you would have had more of the lectures. Then you have questions, perhaps some calculations that you didn't understand. You want us to do again face to face. We'll go through all that. So yes. So this brings us to the end of this session. We'll meet at 4:30 for the next session. Please bring your calculators along.
Okay.
The
Thank
next session,
you.
we'll do a lot of calculation. I'm not going to show you my solutions. I'm going to wait for you to post your solutions in the chat so that I know you are also working. The thing about maths is that if you read maths with your eyes, you understand. But when you take the pen and paper and the calculator and you are solving it, that's when you realize that there was a problem. So that we can solve all the problems you would have with the calculations. Okay. So please don't
Okay.
come and observe. Come and get involved. Thank you.
Thank you.
All right. See you in the next lecture. Okay. Welcome back. Welcome back. So we'll start with valuation of bonds. Valuation of bonds. To know bond price, bond yield, semi-annual coupon bond, and how to calculate the price of a bond. Okay. So on that note, let's just zoom in. You see, so the pricing of the bond, bond is normally an interest only loan normally, meaning that it pays interest over a period and then we'll pay the principal at the end of the period under expectation. So we'll go straight into looking at the price of the bond and what the price of a bond means and all that. So for example, suppose Back Corporation wants to borrow $10,000 for 30 years. The interest rate on similar debts issued by similar corporations is 12% interest rate. Back would thus pay $120 in interest every year for 30 years. That 120 is calculated by the face value times the interest rate. And then at the end of the period, it will pay 1,000 Ghana cedis back. That's the face value of the bond. So it has face value and then it has coupons and it runs on an interest rate or a discount rate. So when you are valuing a bond, you are looking at its fair price or its present value. The price of a bond is equal to its present value or the present value of all its expected cash flow. When we say expected cash flow or expected future cash flows, what we are trying to say is that if you take a bond for 5 years and you are receiving coupon twice a year, or let's say coupon once a year, then you are going to have, let's do coupon once a year. You are going to have 5 coupons over the years. That is 5 cash flows coming in. Year 1, coupon payments. Year 2, coupon payment. Year 3, coupon payment. 4, and then 5. So when you're looking at the price of a bond, you are looking at the present value of all those future coupon money you are expecting to receive, incorporated in the price. That if I'm buying this bond at this price, and I know how to calculate the price of a bond, if I consider the cash flows or all the coupons I'm going to receive over the years till we get to maturity, is the price at which I'm buying the bond, is it realistic? Am I buying it at a premium? Am I buying it discounted? Am I buying it on par value? Is it the price at which I'm buying this bond, the price I'm paying for this bond, is it realistic? Or is it a good cost for me to buy this bond at this price? Okay, so that's what the details mean. So we go straight into looking at the present value of a bond, same as the price of the bond. The present value of a bond, the formula is C over 1 plus R plus C over 1 plus R raised to the power 2, raised to the power 3, raised to the power 4. It keeps going, raised to the power 2. You get to the last maturity date, and then the last maturity coupon comes with the par value. So C plus par value over 1 plus R raised to the power, which number of years we are looking at. So PV is the present value or the price of the bond. C is the coupon payments for each period. The par value is the principal, PAR. That's the principal value at the time of retiring the bond. Then we have the required rate of return or the discount value. And then we have number of periods to maturity. That's number of years it takes for the bond to expire. Okay, required rate of return is our interest rate on the bond. Okay, let's copy this formula so that we can hit the road running. Let's copy this formula so that we can hit the road running. Okay. Please, are we done copying?
Yes, please.
Yes, please.
Okay. Anybody who's not done, please. Okay. No missed consent. So we start with our first question. Suppose the coupon rate on a bond is 4% and the payment is made once a year. If the time to maturity is 5 years and the market discount rate is 6%, what is the price of the bond with the par value of 100 Ghana cedis? What is the price of a bond with a par value of 100 Ghana cedis, lasting or with a maturity date of 5 years, a coupon rate of 4%, a discount or interest rate of 6%? So we look at the formula, then we impute what we have. According to the formula, it says that C over 1 plus R raised to the power 1. That is coupon over 1 plus R raised to the power 1. That's for the first one. Now, our coupon is 4%. But here I have put the figure 4. How do we get the 4? Anybody, how do we get the 4? Remember, we're given a coupon rate. So, again.
Madam, 4% of 100 is 4.
Thank you. So you multiply the coupon rate by the face value or par value of the bond. Then you get your coupon. For those of us who have forgotten the basics, that's why I'm going one by one. So for you to get the coupon, you are not putting the coupon rate over there. It's not 4%. It's 4% times par value or the principal, and that will give you 4. So then we go. Then the lower, the denominator we have, I'm trying to pull out my calculator. Okay. The denominator we have 1 plus R. R is the rate, and we're given a rate of 6%. So you convert the percentage into decimals so that you can have 0.06. That is the 6%. Then you add it to the 1, giving you 1.01, raised to the power 1. And then you continue with the rest. So the second is raised to the power 2, third raised to the power 3 years, fourth raised to the power 4 years. Then in the 5th year, you have your power value at the top. You have the power value plus the coupon. So 100 plus 4, giving you 104. All over 1 plus 0.6 raised to the power 5 in the 5th year. Then we calculate that, and then we add all of them. and it gives us our price, the price or the present value of the bond, which is 91.575. Any questions? You will solve the second one. So this one I wanted to illustrate for you to see. The second one, we will solve it. So before we move to the second one, which is also with like similar behavior, any question? Any question?
Madam,
Hello,
please,
madam.
can you go over once again?
Okay, I'm going over once again.
Thank
So
you.
please look on the formula you wrote. Okay, I'm taking it according to the formula. So our formula says our formula says C over 1 plus R raised to the power 1. That is coupon over 1 plus R raised to the power 1. Now, for you to get your coupon, you will have to multiply your coupon rate by the face value or by the par value or by the principal of the bond. So 4% times 100, and that gives us 4. So you can jot that one somewhere. Is the coupon rate times the par value, or coupon rate times the face value, or the coupon rate times the principal will give you the 4, or the C at the top. All over 1 plus R raised to the power 1. Now our R is our rate. We're given a rate of 6%. You convert this into decimal. Divide 6 divided by 100. You key in 6 divided by 100, which gives you 0.06. So this portion would have been 0.0. It would have been 1 plus 0.06. But I've added it already. So when you add 1 to 0.06, you get 1.06 raised to the power 1. The same thing is what happens at the denominator. So the second one is raised to the power 2, the third raised to the power 3, the fourth raised to the power 4. And then in the 5th year, where we are retiring the bond, or when we get to maturity, the formula says C plus par. C is coupon. Coupon plus par. Coupon plus par. If you are doing coupon plus par, then you have your C, which is 4, plus your par of 100. When you add that, you should get 104 divided by your denominator of 1.06 raised to the power 5. Then you use your calculator. 1.06 raised to the power 1, whatever you get, 4 divided by 1.06 raised to the power 1. If you don't want trouble, you can do the denominators first. So you do 1.1 raised to the power 1, you write it down. 1.1 raised to the power 2, you write it down. Raised to the power 3, you do all that first. Then you come and divide 4 divided by whatever you got at the bottom. If you are very good with your calculator, you do your 4 divided by into brackets 1.06 raised to the power 1. You do it straight ahead, and then whatever you get, we add all the figures together, and it gives us 91.775. And that's it for calculating the price of a bond that is paying coupon yearly, once a year. Coupon payments made once a year. Okay.
Madam, I want to ask a question.
Yes, please.
What does it mean by this bond is described as trading at a discount because the price is below the par value? Does that mean that even though I pay 100 CDs at the beginning for 5 years, and I'm going to receive these amounts, when I add it after the 5 years, my amount would still be lower than what I put in?
Okay. So it just says that the price of the bond is lower than the price you paid. The price of the bond is lower than the price you paid. Do you get it? Sometimes you get a bond that is like that because they have, how do I put it? They have you have minimal risks on the bond, so you are not at any risks investing with them. Okay, so they are selling at a discount, but you will buy because it is still the best value you can get in town. Do you get it?
But eventually, what I'm going to get will be lower than what I put in at the beginning.
What you are not lower. Remember that there's going to be what you are enjoying over the periods. If I was doing adding time value of money, do you get it? If you are doing time value of money, you see that what you are receiving is still okay. It is not like they are keeping all the money till the end of the period and they are giving it to you. No. But you are receiving value over time. So the market price is below the face value. And you have to decide whether it is worth buying that bond or not. It's like you buy Ghana after what happened to us. Anybody who does price valuation of our bonds and realizes that we are selling at a discount will not buy because we are very high risk. You get it? We are very high risk. So if the person realizes that he's trading, it is trading below its face value, the person will not buy. So usually our bonds are trading either at par or above value.
Okay.
Okay. All right. And sometimes they compensate with interest rates. Until when you value it, you realize that it will go up. It will go up. It's just if you are buying a foreign bond, a dollar bond, and even your face value is lower, you will buy that dollar bond because you calculate and realize that the price is lower than the face value. You buy that dollar bond because you know that the price of dollar, the value of dollar keeps going up. So it compensates you on that side. So you will still buy. So it depends on which bond you are buying and the things playing. I want to use the right word. The environment, the conditions. Yes, the conditions at play with the bond that you are buying. If it's a dollar bond and I'm buying it now at a lower face value, and I'm buying it at 100, but I know that when I do my calculations, it is at a lower face value. I'll still buy because I know that the dollar rate keeps going up in most countries. So even if after 5 years it is 95, it will be 95 times a higher rate than today as I was buying the dollar bond. Yeah.
Okay.
Okay. So let's look at this one. Let me move this thing up.
Madam.
Yes.
I have a question.
Yes, please.
Based on the present value of the bond.
Yes.
If a finance manager is focused on long-termism and another is also focused on short-termism, how would you advise based on the present value calculated?
If a finance manager is considering short-term what? Short-term.
Yes, and also long-term.
Yes. So short-term and long-term, and it's a CD bond.
Yes,
or
please.
a dollar bond.
CD bond.
A CD bond.
Yes.
Well, at looking at the risks involved, I wouldn't advise a long term. is tricky. Well, long term means that maybe 10 years or yes, and 5 years. You see, we can't use the long term and short term to determine whether it is risky or not. It could be short term problem. Let's say last year you bought 2016, Mahama left. 2020, you bought a bond. And then from Ghana, 2020, you bought a bond. Then by 2022, so let's say you were doing long term, right? 20 long term of 10 years, short term of 5 years. By 2022, the bonds had already started losing value, losing its credit worthiness, and all the problems that came with it. You see that if you were looking at a short term, then you'll be at risk because your bond was going to mature at a point where the country was still in crisis. But then you would say that maybe the long term is better. What if the short term is better? Maybe by the 10th year, you can't even receive your money at all because you can't actually estimate what happens to the African country. God forbid, if there's a electoral misunderstanding, change of government, and we won't agree, this person has won, we won't agree, we two will not agree, then we are in chaos. Your 10-year bond will still be at risk. So the number of years is not enough to value whether it is the better option or not. Yes, but then you have to look at the credit rating that comes with the bond. I remember when we did the haircut, our credit rating went very, very low from S&Ps and Moody's and the rest. You heard them in the news. Our bonds was graded from B to, I think, C or D. Yes, and which means that they are very risky. So if you are going to buy that kind of risky bond, and they haven't done revaluation, so I don't know whether the rating has changed. But if you are buying that kind of bond from a country like us, who showed you our behavior a few 2 years ago or a few 4 years ago, then you are actually looking at the rating that has been given to our bond and then compare it to the price at which you are buying after you've done your calculation. You should certainly want to buy it at a premium. It shouldn't be a discounted one. If it's discounted, you are shooting yourself in the foot because we are high risks. Do you get my point?
Madam.
Yes. Yes. We are high risk, so you won't want to buy our bond at a discount, especially when it's valued in cedi. If it's valued in dollar, you will tell yourself that, okay, apart from this risk, if they do well and I get my money, the value is a dollar value. The value of the dollar would have gone up or wouldn't have dropped so much. We have dropped, but we still are not at 1-to-1. So you won't lose that much. But if it is a cedi bond and we are graded at D and you still buy at a discount, the risk is too high. The risk is too high. Hope I was able to help.
Yes, madam. Thank you.
Thank you. So let's look at this question. Suppose that another 5-year bond B, has a coupon rate of 8% paid annually. If the market discount rate is 6%, determine the bond's new price with a par value of 100. So you see that the rate hasn't changed. The coupon rate has changed, but the denominator, the interest rate, has not changed. So let's value this bond and see how it is playing, whether it is at a discount, premium, or at par.
Doc.
Yes.
Yes, I got 33.699.
Okay, 33.699.
99, yes, my final answer.
Okay, kindly let's put our answers in the chat. So 33.699. I'm putting it here.
Yes. All right.
Yes, let's put our answers in the chat so that I can compare them. Also, so that you don't influence somebody's answer. Okay, yes, I've seen Papa Sam. I've seen your answer. I'm waiting for
Then I'm
to
wrong.
get. Then is it Nadia? Nadia, I've seen your answer. Steven, I've seen your answer. Abdul, I've seen your answer. I like the participation. It's very important for me. Okay. I see two varied answers. It is shifting. We are at par. Between the 33s and the 108s, it is at par. So let's see. I think I have, do I have a lady? Nadia is a lady. Dinah is a lady. Let me mention it correctly. Then Gazy. All right. But do I have only two ladies here? Joyce. Okay, I've seen Joyce. I've seen Obey. I've seen Ima. And then I've seen Gazy. It's not Gazy, but let me pronounce it like that. Thank you. So Asari, I've seen yours too. Stephen Baffo, I've seen yours too. Thank you for the participation. So let me unveil the answer and let's see what we got here. This is from there's someone's answer, but I can't see the Gina. Gina, I've seen your answer too. Thank you very much. Okay, so the Isaac, I've seen your answer. The 108s are winning. Let's see what happened with the 33s. Anyone who got 33, would you want to tell us where you went wrong? Looking at the answer we have and the calculations we've done, so that we can help you out.
Oh, yeah, the 80.708.
80.7.
The last one, yes.
Oh, okay. What did you do?
So I continue with the 4 instead of the 108 here.
Oh, okay.
So can you please go back and explain that one, please?
Yes. So the last one here, the 50 year.
Yes.
Have the formula says C, the coupon, plus the par value. So your coupon is 8 and the par value is 100. So when you add that, you get 108 divided by 1.06 raised to the power 5. So you had a problem with the 108, eh?
108, yes.
Okay, yeah. So it's the par value plus the coupon.
Okay.
Okay.
Thank you.
Okay. I see, Gilbert. You sent us your answer is correct. Thank you very much, and I appreciate the participation. Thank you very much. All right. So anybody else with a question? Anybody else with a question? Okay. No. All right.
Hello, Doc.
Yes.
Please, my problem is that what if the maturity date is not 5 years but is 10 years? Are we going to add data to 10 years, or we have a formula for
There are
another
other
formula?
formulas. There are other formulas.
Oh, okay.
There is the annuity, the perpetuity formula, and all that. So we are moving small.
Hello, madam.
Okay, madam,
Yes.
please, thank you.
So, Doc.
Madam,
Yes.
madam,
Yes, I
please,
can
can I
hear you.
come in?
Yes, I can hear you
So,
coming.
looking at our conclusion, this bond is trading at a premium because its price is above par value. How do
Yeah.
we get the conclusion whether it is premium, whether it is discount, and
Oh,
those?
okay. So after the calculation, we got a figure of 108.425. The price of the bond, the par value we were given was 100. And our calculation said the price of the bond should be 108. Okay, so then we will say that the bond is trading at a premium. It's trading at a premium. It's not discounted, and it is not at par. It is trading at a premium because it is giving you more than you are paying for initially. At the end of the period, you would have more than you have paid for initially. Is that okay? So you are comparing the par
Yes,
value
madam.
and the results you are getting. That's where you decide.
Okay. All right, madam. Thank you.
Yes. Yes, I saw your hand, Churi.
Yes, Doc.
Yeah.
Yeah, for the first example.
Yes.
Okay, the last year, that is the year 5.
Yes.
So because I can see the second one, we have added the par value to the rate, but the first example is this. Oh, is it the same?
Yes, 104. We
104,
added
yes.
the 4 to the 100.
Okay. You are right. Thank you.
Thank you. Okay, so let's try this very last one. So you see, let's analyze what happened here. We realized that the par value didn't change. The interest rate or discount rate didn't change, but the coupon was the deciding factor. So the coupon rate was higher than the first one. The first one, we had a coupon rate of 4, maintaining other variables the same. The second one, we have a coupon rate of 8, maintaining other variables the same. And you see that just by increasing the coupon rate, which is the value you get periodically, it changes the price of the bond. Okay, so I wanted us to note that the coupon rate was influencing the total price of the bond. Let's do this very one. The coupon rate is 6, discount rate is 6, par value remains at 100 and is going for 5 years. Let's see what we get from this one. Okay, answers have started coming in. I have, yeah, Gloria, I have received your answer. Emmanuel Gazy, I've received your answer. Papa Sam, I've received your answer. Sandra, thank you very much. I've received your answer. Oseb Wate, and then Ima, I've received your answer. Diana, I've received your answer. Thank you. So I think we are heading somewhere. We are heading somewhere, and yeah. Asari, thank you. Gina, thank you. The others, I want to be seeing other names. These are similar names that keep coming in. So let's all get involved. Okay. Let's not be left behind at all. Derek, thank you. Abdul, thank you. Joyce, thank you. Okay. Yeah, so we are trading at par. Leslie, thank you. Jane, thank you. So we are trading at par. Yes. We are trading at par, and that means we are buying at the same price. Okay. It keeps coming. Who's this? Turi, okay. Ibrahim.
Ibrahima Ture.
Ibrahima. Okay, Ibrahima. Yes. So it's not Ibrahim. Ibrahima.
No, it's Ibrahim, but they are all the same.
They are all the same. Okay. Yeah. Nadia, Martin, Patience. Hey, I'm seeing names. Thank you. Thank you. So we are looking at what it means, the relationship of the coupon rate to the market and to the discount rate. So that when the coupon rate is less than the market discount rate, the bond is priced at a discount below par value. If the coupon rate is lower than the discount rate or the interest rate, the bond will be trading at a discount. If the coupon rate is greater than the market rate or the discount rate or the interest rate, the bond is priced at premium. So just by looking at the relationship between the coupon rate and the discount rate, you'll be able to tell off head whether the bond is traded at premium or discount. When the coupon rate is equal to par value, we see that the bond is trading at par. Oh, when the coupon rate is equal to the market discount. Yeah. Okay. Kweku, please look at your answer again. Either you typed the wrong answer or you got it wrong. If you got it wrong, then I go back and help you find where you went wrong. Kingsford, I've seen your answer and it's correct. Ima, your answer is different, and I would want to address it. So let me show what we got, and let's see. This is what we got. Are you able to tell where maybe the problem may be coming from?
I'll save it. That's my mistake.
Are you okay? Or do you need me
Yes,
to go?
yes, madam.
You
No,
don't need me to. You're okay. All right.
Yes.
All right. Thank you. So then this is a typical exams question. If I ask a question in the exams, you won't be seeing all this simple English that I've written here. No. This is a typical exams question. Identify whether each of the following bond is trading at a discount, at par value, or at premium. Calculate the prices of the bond. Calculate the price of the bonds per a. This is wrong. Let me frame it. Calculate the price of the bond with a par value with 100. Let me do dollar par value. It's my dollar sign. Okay. $100 par value. Here. Calculate the price of the bond with $100 per value. Okay. You have the bond A, B, C, or D. So bond A has a coupon payment of 2 per period. Number of periods to maturity is 6. That makes it 6 years. The market discount rate per period is 3. So discount rate is 3 for 6 years, a coupon payment of 2 per period. Then that goes for A. So B, coupon payment of 6 per period. Number of periods we have, number of periods to maturity, we have 6. We have 4. And then discount rate is 4. And it continues like that. I wish I could demarcate, I could divide us so that we'll answer, from different points. But if I do it, I can't. I don't have a list of the class. Okay. So let's go. Let's do one. Let's do A. Let's do A. When you're done with A, you can shoot your answer. You can go ahead to do B. You can go ahead to do C. This is supposed to give us a different view and to see if we can understand the format that has been placed here and whether we can interpret that into the formula. So we'll end at 2, at B, so that it won't take a lot of our time. We'll end at B. So let's do just A and B. If you don't understand anything from the table, kindly let me know. Yeah. Okay, we have answers coming in. Okay, Sam. I've seen answer from Sam, Abdul, Osei, Barton, Gazy. Yes, that's 5 of us. I'm waiting for another 5 of us. So those of us who are done with A, let's do B. Let's do B to buy time. Okay, so I have Joyce, I have Richie, Sandra, Esther, Emmanuel, yes, Nadia for A and B. Wow, thank you. Stephen. I see your answer for A. Okay, so let me unveil A.
Madam, Stephen is A and B.
There's still A and B. Oh, so you gave me the A and B. Oh, okay, I see A and B, yes. Thank you very much. The last one that just came was Patience. Isaac. I see Patience A and B. Isaac. Okay. Then the B's have also started coming. Gazy is coming. Sam is coming. Jenna, I've seen your answer. Or say I've seen your answer. So let me unveil A then. Let me unveil A. I don't want to miss anybody. So Abdul and then Turi, I've seen your answer too. All right. For B, before I can unveil, okay, I can unveil easily. Yes. So for bond A, we have 94.58. Bond B, we have 107. Now let me go and look at my answers. 107, 107, 94. Yes. 107, 107, 94. Any 107. Okay. So Gilbert, you would look at your second one again. Let me see. Yes, it's too far. I would have 97, 90. Someone had 97. Patience. Look, don't add too many decimals to it. It makes your rounding up go very high. I'm sure that's how you got 97. So look at it. 107. Esther, thank you. Asari, thank you. Yes, so 107 is correct. 94 points, whatever at the back is correct. Okay. Any questions from here? We won't do C and Papa Sam 93.66. Okay. I think you have dashed a lot of the decimals away. You got 93. Otherwise, you get 94. The points I don't mind, but we should get the figure. Let it be very close to the original figure. Okay. I think we are good here. But any question? Anybody with a question before I move to semi-annual? Before I move to semi-annual, anybody with a question?
Hello, madam.
Yes.
Madam, so in order not to go through all these processes, do we have maybe one formula that maybe when we input it, we can just get the answer directly without going through year 1 year, 2 year, 3 year, 4 year, 5 years?
There are so many formulas depending on what you are looking for. And as we go on, we'll be exposing ourselves to those formulas, the annuity formula and the rest. The formulas, the baby, ordinary annuity, what annuity. There's even formula for whether you're investing at the beginning of the year or at the end of all of that. But it also depends on what you are looking for.
Yes.
Back with your patient. So there are it depends on what you are trying to calculate, and then how many years is involved. But we are starting from the basics before we get to the others. So that's why we are picking it from here. Okay. So we'll move on to do semi-annual. The other two, the answers are here. So when you take the slides, you'll be able to work alongside it. Semi-annual. Now for semi-annual, it's just the same as the first one. Kindly mute for me. For semi-annual, it's just like the first one, but this time there are two coupon payments in a year, and that is why we call it semi-annual. There are two coupon payments in a year. So instead of annual payments, one-time payment is divided into two. If it's divided into two, it means that the coupon is divided into two. The interest rate is divided into two. So you see a bond, and they say that the bond is paying semi-annually with a coupon rate of 5%. It means that 5% quoted is for the year. But for semi-annual payment, you divide by 2. You divide the coupon value by 2. And then you go on. So once you divide the coupon by 2, you divide the interest rate 2 by 2. Because if the interest rate is stated as 6% per annum, it means that 6% is for the year. So you have to divide it by 2 before you can have the semi-annual portion of it. Then the time or the year to maturity, number of years to maturity, is also multiplied by 2. Divide coupon rate by 2. Divide coupon by 2. Divide discount or interest rate by 2. Then you double the number of years. Why do we double the number of years? Because in a one-time payment, let's say we are buying this bond for 3 years. In a one-time payment, we'll have 3 coupons coming in by the time the bond is at maturity. But when you are dealing with a semi-annual payment, which gives you 2 coupon payments in a year, that means in year 1, you have 2 coupons. Year 2, 2 coupons. Year 3, 2 coupons. That gives you 6 coupons over time. So you multiply the number of years, 3 times 2, to give you the number of coupons you are going to receive. Okay. The number of years, multiply it by 2. So that it gives you the number of coupons that you are going to receive. And you are discounting each coupon. That's what the calculation is doing. Discounting each coupon by the number of years it is. And so you have C divided by 2 over 1 plus R divided by 2 raised to the power 1. Remember, this raised to the power 1 is not to only the R. It is for all that is in this bracket. So you have 1 plus R raised to the power 1, like before. Just that now we have divided the R by 2. The second year to your coupon is divided by 2. Your rate is divided by 2. And you do that to the final year. At maturity, you have your coupon divided by 2 plus power value that is not touched. Then 1 plus rate divided by 2 raise the power n times 2. That is the number of years times 2. The number of years times 2. So when you get the question, if the question is saying 4 years, it means that you are going to multiply 4 by 2, which will give you 8 years. It means you are going to calculate 8 coupon payments for the period. 8 coupon payments for the period. Any question? on that one before we move? Okay, Anthony, I see your
Okay.
I see your answer. Yes, please ask your
I
question.
want to find out, can't we just calculate for the year and then divide by 2?
No, please. No, because each time you collect a coupon, we are discounting the coupon. We do a discount. The divided by 1 plus R is a discounting of the coupon for that period. So you can't calculate and divide it by 2 because raised to the power 1 and raised to the power 2 are different. It will give you different answers. So you can't do 1 and divide by 2. No. Those of us who did time value of money, you remember semi-annual calculation. It's the same principle that is being applied here. Those of us who have done time value of money before. Yes. The same principle. So the principle is to divide the coupon, divide the interest rate, multiply the number of years by 2. So when you get the question, look at the years, ask yourself, how many calculations am I doing? Multiply the number of year by 2. It will tell you how many calculations you are doing for coupons. Or when you get the question, ask yourself, if they said the bond is running for 2 years, semi-annual payment. If it was annual payments, how many coupons will I receive? 2. But now it is semi-annual. So how many coupons will I receive? 4. It means you are doing 4 calculations. Year 1, year 2, for the period 1. When you receive your first coupon, second coupon, raise to the power 2, third coupon, raise to the power 3, fourth coupon, raise to the power 4. And then that's how it goes. Okay. So let me unveil. Okay. All right. Consider a bond with $1,000 par value, a 10% coupon rate paid semi-annually, and 3 years to maturity. Assuming a 12% required rate of return, what would be the present value of the bond? Present value or price of the bond. $1,000 par value, 10% coupon rates, paid semi-annually for 3 years, an interest rate of 12%. So I have Emmanuel Gazy. Kingsford, look at your answer. I think you left something out. And then I have Abdul is also here. Oh, for A, the first one we did. Oh, okay. Okay, thank you. For A, the first one we did. Okay. Thank you for completing it. Esther, I can see your answer. Thank you. I'm impressed. I'm impressed at the answers I'm receiving, so it's good. Yeah. Okay, Papa Sam, I've seen your answer, Kingsford. Thank you. Patience, thank you. Gina, thank you. Daniel, thank you. Is it Leslie? I've seen your answer. Sorry, I've seen your answer. Thank you. Ernest, I've seen your answer. Thank you. I think we have enough answers coming in. So I'm going to show my answer, hoping that I am not moving too fast for the rest. Emmanuel, I've seen your answer. Thank you. The rest, don't, if you are solving and I'm moving, please, sorry, I hope I'm not moving too fast for you. But once we have a few coming in, I want to show. So 950 is the answer, and I think practically everybody got that correct. Everybody got that correct. Everybody. Yes, everybody. And I am grateful for your solution. Thank you for attempting, and thank you for your understanding. When you meet Dr. Nsia, we won't have a lot of chaos because your maths is quite okay. Your maths is quite good. So thank you very much. We don't have a lot of struggles. If you are struggling, you don't want to, sound it here, kindly contact me after the class. Let's do our special explanation, okay? I know that sometimes people don't want to talk in a group when they have a problem. So if you are one of such, you can take my number from your class rep and then contact me directly, and then we can explain what is troubling you, and then you can also be at par. Thank you. So I think the last one that came in was Stephen. Yes, Stephen, Emmanuel Kumi, and then Emmanuel with a mobile number. I see. Thank you very much. I think there's a hand. Did I see a hand raised up somewhere?
Yeah, yes, madam.
Okay.
Madam, it's me, Emmanuel.
Okay, what's the question?
I could see that. So that's so it's like the last power. That will give you the number of years that we should calculate for. Because I could see that after getting the 2 times 3, give me 6. So that's why we got the 6.
Yes.
The number of years.
Yes.
Okay. Okay.
Yes.
Okay. Thank you.
Thank you. Okay. So we are all good on this one. Or is there a question? Okay. Should I continue with the mass or we are exhausted? Okay, let's do the zero coupon. Zero coupon means that it doesn't pay any coupon at all. At all. Till maturity. It doesn't pay any coupon at all till maturity. So you have year 1, year 2, year 3, year 4. Coupon is 0. Once coupon is 0, the top is 0. Anything divided by 0 is 0. So even if we say 10 years, semi-annual, quarterly, whatever it is that we are saying, once it is a 0 coupon bond, you are not solving anything till the last year. The par value divided by 1 plus R raised to the power the number of years. And that is 0 coupon bond. The easiest to calculate. 0 coupon bond, the easiest to calculate. Okay. So please copy the formula. We'll solve just one question for 0 coupon. Sorry. Are we done copying?
No, please.
No, please. Okay, thank you. Who didn't know?
Sweet. How does this
Okay, so I guess we finished copying this one. So let me show the question. So consider a 0 coupon bond with 3 years remaining to maturity and $1,000 par value. Assume the investor's required rate of return on the bond is 13%. What should be the price of the bond? It has par value of 100, coupon is 0, and interest rate is 13.
Par value of 1,000 or 100?
1,000, sorry. 1,000. Okay. I have my first answer coming in. Okay, so 2. I have Sam, Sem, Gazy, yeah. And then I have Dinah, Abdul, Papa Sam, Emmanuel, Nadia, Joyce, Kingsford. 3 more. 3 more, then we move from this one. Gloria is in, yeah. 2 more. Stephen is in. 1 more. Patience. Thank you. Thank you very much. So let me unveil our answer. Okay. Yes, I have Gloria coming in. Okay. Patience again. It's a different patient. Okay, these are a different patients. Ernest, Esther. Okay. So our answer is 693, and I think almost all of us, almost everyone had the same answer, 613.1. 613.01, 05, 613.1. Correct. 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 Okay. So any question on that before I move? No question.
693.48.
693.48. Okay. I think maybe you were how you treated the decimal. No, there's no decimal even here.
The last one.
1.13. We'll give you 1.13 raised to the power 3. It should give you a definite value. It shouldn't be that far. So check it out again. Check it
Okay,
again.
I've seen it.
Okay.
I made a mistake somewhere.
Yeah, thank you.
3, I made it 03.
Oh, yeah. So because that gives you just one value. Yeah. Okay, then we are looking at.
Madam.
Yes.
I want to ask a question.
Yes, please.
Looking at the zero coupon bond.
Yeah.
Assuming it is in cities, what would have been the motivation for an investor going into this kind of bond?
The way you said CD, I knew you were going to say that. Well, perhaps the value is I don't get the motivation. I don't get the motivation because you can definitely see that the resulting price present value is lower than the face value, the par value. So if you are buying this and there's no coupon coming in, I don't know what will motivate you to buy it. But someone buying this in let's say this zero coupon bond in an African country, let's say you are in Ghana and you are buying $1 bond, outside the country, or even if it's Ghana, you are buying a dollar rated bond, or a dollar denominated bond, your motivation would be that though the price, the face value, as you see as par value compared to the price of if the embedded price is lower, it is a dollar investment you are making. And in the next so they said 3 years to maturity, which means it has been running before. So even if it was 10 years or 5 years, you believe that the dollar price would have gone up. 10 years ago, let's see. 10 years ago, what was the dollar rate for Ghana? If you can imagine that 10 years ago, even in 2016, the dollar was at 4 point something. So today we are in 2026. So 10 years ago will be 2006. Yes, 2006. What would have been the dollar rate? Who was president at the time? Anybody remember?
Kufuor was the
2006.
president.
J.A. Kufuor.
J.A. Kufuor. Aha. So, and then within the denomination, denomination,
Revaluation.
yes,
In
in which
2007.
year?
2007.
2007. Good. So, if you bought this 10 years ago, dollar by 2007, the dollar was 1:1. And you bought this. Today, the dollar is how much?
Around 10.9, 10.8.
Ash. Can you see the profits? That is 1:1, and now it's 10 point something. In fact, if you made a mistake and calculated 2 years ago, would have been 14 point something. And so you see, it would have been a very good investment. It would have been a very good investment because at the time, in fact, that was even before. So 2006, no, it wasn't even 1:1. It was we valued the thing to become 1:1. So that you see that it will be like 100% because we did a 10,000:1. That is what we did. So you would have had about 100% increment in the money you invested. And so that is why the dollar is more interesting to do than a CD. If it's a CD investment, I don't know. I personally won't have any motivation for a zero coupon bond. It's like I'm not going to get anything. My money is just going to be there, sir. I'm not going to get anything. And then at the end of the period, and it's not everybody that knows this. People buy without doing any valuation. So they don't even know the original price or the embedded price of the bond they are buying. They are just buying because they are making investments or they've seen coupon rate that they feel is good. But what is really, really embedded in what they are doing, they don't know. Yeah. And so this is where your investment manager comes in, or your portfolio manager comes in, takes your money, invests it for you, and say, no, this bond is selling at a discount. We don't like this one. We like this one. This one is dollar. In the next 10 years, the dollar would have gone up by an estimated value of this. And looking at the Ghanaian economy over the years, our dollar rate has increased every 10 years. We have this rate of increase. Every 10 years, we have that rate of increase. And they have all that data available. And they look at that and then they make the calculations and decide that we should invest in this other one and it is better. That is where they come. Yeah. So I won't get motivation for this one. Sorry.
Okay, madam.
Yes.
assuming I have a dirty money, would this be a nice, yes, would this be a nice opportunity for me to make it clean so that it will pass through the regular system for me to come clean, that nothing bad has happened, the money came from a genuine source?
Unfortunately, you can't even hide it, because we are when you go to the bank to deposit a huge sum of money, they look behind the money, they trace the money. Any banker over here, they won't tell us. They do. That is why some people do money laundering, because once you are passing it through the regular system, we will find out where did you get this amount of money. You can't just suddenly make it clean. You can't suddenly make it clean. That's why some people do a lot of business. It's like small business. You ask yourself, I don't know if you've asked yourself before, how much are they making from this business that makes them want to open so many branches? That's because they must find a way of, leveling their money, putting the money in the system and making it become like legal money. I'm tempted to use example, but this is public. I can't use the examples that are in my mind. But you realize that if you are a finance person, you look into businesses and you know how businesses work. You know that somebody cannot run this business and within a short time, they have enough money to do this and to do this other one and to do this other one. So you should want to look into what is happening there. So yeah, you won't even, it maybe some 5 years ago, some 10 years ago, you could have done that. But now they've tightened the system up. The security measures are higher. So you can't even take dirty money and pass through the legal system. No, it won't work. It won't work. You rather spend it. That one, yes. You can spend it and won't find out. But once you pass it through the legal system, we'll find you. So you can buy a car from some the people who sell cars. How do we call them? The car shops.
Garage. Those garages.
Garage. Yes, you can buy a car at garage, Mr. Simpe's garage or Mr. Ologu's garage or Mr. Something's garage. He's not interested in where your money is coming from. He's just selling his car. And he has documentation that he has bought a car into the system. So if he takes your money that you have bought the car and he puts it in the bank, he has documentation that show that he bought a car and sold it. So they can't follow him. So that's why people who do that, they spend a lot so that they can put the money in the system. If the person buys 3 cars and after 3 years he's selling those 3 cars, you cannot trace the money. He got dirty money and bought 3 cars and kept them for some years and sold them. You can't trace it. So that's how it is. You can't do dirty money and go free. See how they bet you.
The system is working.
The system is working. You see how they bet you. Okay. So imagine, you ask yourself how many what do you call this? These people who change money.
The black market.
Forex bureaus. No, the forex. How many forex bureaus are in the system now? Most of them have closed down. Yes, they didn't collapse. They closed down so that you can't come and find out, like fish into their business.
Okay.
Yes, because now the system has been tightened up. So if the listing, they'll be caught. So they will close up and do other businesses. Or as for money trading, they will catch you. Now let's look at computing the yield. Let me see my time, 8 o'clock, 6 o'clock. Okay, so let's compute the yield. The yield is the interest rate So you are given the price, the cash flow, and then we are looking for the interest rate at which that investment is being sold. Okay. So when we take it from the present value, we have cash flow over like coupon. I'm using the same formula that we had here. The same formulas that we had here. Okay, so you have coupon. Coupon is cash flow that is coming in. So cash flow at year end divided by 1 plus y. Y is like R, but because we are doing yield, that's why we change it to y. Raise the power n. Okay, so you solve for y, and because I didn't want to confuse you, you solve for y means the original formula for yield is equal to cash flow raised to the power n divided by the price into bracket raised to the power 1 over n minus 1. The formula is getting complicated now. We are moving forward. So you have CF, which is the cash flow, divide at point n divided by P raised to the power 1 over n minus 1. Let's copy this formula and then we'll try our hands on it. Okay, I think we can move on. There are other formulas for yield. We can use those too. Suppose that the financial instruments currently selling for 62,321 promises to pay 100,000 6 years from now. Find its yield. It has given us selling price, promises to pay 10,000 6 years from now. So you must be able to determine what 62,000 is and what 100,000 is.
Hello, Doc.
Yes.
Please, can you solve this one with us so that we will solve the other?
Okay. What is your difficulty? The formula says C, cash flow divided by P, price. Okay. Now, let's see. Let's break it down. Suppose that a financial statement instrument currently selling for 62,000, selling for 62,000, selling for. So what would that one be? It is selling for 62,000.
That's the price.
That's the price. Thank you. Promises to pay 100. That should be our cash flow. It promises to pay. So that's what's going to the cash flow coming from the investment. So you have your 100 as cash flow, you have your price. The rest is a done deal. But like you said, let me unveil. Let's solve this one and then let's see. So you have your 100,000 divided by your price raised to the power 1 divided by number of years 6. Okay, there's someone said something. I want to go and see. Okay, someone has calculated yield. Thank you. Thank you. I unfortunately I have jumped the thing for you. So sorry. Abdul, I'm very sorry. Next time I'll wait. Yes, you had it right. 8.2. So you divide, you have your 1, as the formula stated here, 1 divided by n. So your n is the number of years, which is 6 years. So 1 divided by 6 minus 1, as stated in the formula, minus 1. Okay. The rest is calculator work. You divide your, you do your division here, your 100,000 over 62,000, giving you 1.60459, raised to the power 1 over 6 minus 1. Then you do 1.0, Esther, I'm coming. I don't know. Did you say something? Or I saw your name pop up. So you do your 1.60459 raise the power 1 over n. It's on your calculator. You will see x over 1 over x. Some calculators have it as 1 over x. I think others have it x over y, which means that you have to key in the top and key in the down. And then you do the, once you use the calculator to solve the brackets, then you get your 1.082 minus 1. The rest is your ability to manipulate your calculator. But the main work is to be able to determine which one is the price and which one is the cash flow. Once you have that, the rest is just your calculator. And then we go. Any question? Or somebody needs me to go over it again?
Doc, please, thank you. I got it now. I was confused with the formula. Please go back to the formula.
Okay, so the formula is...
The formula, you see, there's n, the cash flow, n will come before dividing the price.
Yes, the n
I was confused over there.
Oh, okay. It's saying cash flow at year end.
Okay.
Yes, cash flow at year end. So the cash flow is coming in the 30th year. So you don't need to put 6 over there. It's just the cash flow. So I guess that's I guess what you are saying. I get that.
Okay, madam. Thank you very much.
You're welcome. So I think I have just one question for that. Class rep, please remind me to upload a couple more questions for you to try your hands on. That one is not homework. It's not compulsory. It's just for you to try your hands on it if you want to. So the mathematical question that I'm going to put there, it won't be compulsory for you to submit. It is the one on the haircuts that will be for submission. Okay. Then we have spot rates. Now, sometimes there are bonds that are valued based on interest rates variation. Okay, interest rate variation, and then we call that valuing using the spot rate. So the interest rates vary over time, and that is the spot rate. We just use each rate per each interval, rate per each interval. At a point where the coupon is coming in, what is the prevailing rate? What is the prevailing rate at the time? And then we use that. And that also has its formula. Reading as cash flow in year 1. Oh, okay, I hear. Asari says that the mass is too much for a day. I don't know how many people are of the same view, so that we would break for now and then continue again. We are tired. Okay, I'm getting the response. It's true. Oh, okay. Yeah. Yeah. Let me get your consent. Keep it coming. We are hungry. Oh, okay. All right. So I'll take a break over here and then we'll continue next week. The stress. You've had class since morning. I understand that. Is my class the last you have for the day?
Yes, please. 6:30.
Okay.
Please. 6:30.
For 10 minutes.
You did quanti today and that stressed you up too. Oh, okay. So I'll take a break. We've done quite a lot, and the time is 6:20. We just have 10 minutes more. So I think that we can take a break over here.
Thank you.
All right. So thank you very much. If anybody had enough capacity to continue and we are stopping, please, we are very sorry. But I don't want
Let's continue.
Emmanuel, we beg you, man. We beg you.
Someone says he's enjoying the class, you should continue. Oh, okay. Someone is just breaking your fast. I didn't even allow you to go. So sorry. So I'm taking a break here. And
Thank you.
We'll continue next week. Okay.
Madam, it means we're not meeting the face-to-face next week. We are not doing that.
Yes, class rep. Class rep, are you here?
Yes, okay, please, I am.
Please speak to your class.
Okay. Yes, please, I will.
You want to talk to them here or you talk on your page?
I think I've already posted the response after I spoke with you, so kindly check the page.
Okay, so we are not, I learned is it Quanti?
Yes, Quanti.
Yes.
He won't be available. It means if we are meeting just because of our class. And some people will be traveling, outside Accra to come. So we would want to hold on and meet on the same day that Quanti is meeting you so that we can have an arrangement. Okay. All right. So next week will be online.
Okay, madam.
All right. Thank you very much.
Thank you.
Have a lovely
Thank you.
Enjoy your evening.
Madam, we know they get you.
Okay. Bye.
Bye.
Bye. It's good.
Gezi. Ubasha hunye wati.